On today's hot sheet, I'm discussing housing inventory data for the past week. More homeowners are showing rates above six than below which number for the first time in 5 years. And 13 states are now thinking about doing what Florida's doing, eliminating property taxes. Today is Monday, March 2, 2026. I'm Byron Lazine, and the hot sheet starts now. Live here from the Connecticut studio. Beautiful here in Connecticut. Actually, the sun was shining when I landed yesterday, so I will take that. Got Bobby in studio. Haley's out today. All week.
Haley abandoned us.
She'll be back. Don't worry. She will be back, and we won't have to have Bobby on the hot sheet when she comes back. But we love Bobby on the hot sheet. It's a pleasure to be with you wherever you may be tuning in from. Thanks for taking a portion of your day and your morning here on the live call to be with us on the hot sheet. We do this show every single Monday through Friday when the markets are open. It's the 24-hour look back for real estate professionals. Anybody who cares about the real estate profession, it's the only show that does this each and every single day on the 24-hour look back of what's happening with our housing market. What could potentially impact the housing market? It feels like a totally different world from Friday morning show here to today. And there are things that obviously do impact rates, and we'll take a look at that. First, let's take a look at where we're at on inventory here for the past week. Are we finally seeing the start of the natural progression up on inventory? We are now into March. It's a new month. I feel like March, here we go. It's go time. We've been waiting and waiting for what we could consider really the start of, peak seasonal months. And it is starting now. If you're an agent who cares about having a huge 26 and you're taking a 2-week vacation in March, I can't figure out your calendar. That makes no sense to me. I've always said, March to July 4, it's go time. It's go time for agents because this is when the biggest peak opportunities, the biggest help from the market it's right now. It's now until July 4. And so are we seeing it in inventory? Well, we're not seeing it in inventory just quite yet. Okay. Inventory here dropped in the last week of February 20 to 27. We saw inventory on single family homes, according to Altos Research, drop out about 10,000. Okay. It's from just over 700,000 to the low 690,000s. The same week last year, it moved flat. But it's at this point every year, the beginning of March, that you will see a climb up and a continuous climb up on inventory from now until, call it the 4th of July or shortly thereafter, when you see a flattening on inventory throughout the summer. Inventory growth is 8.04% over where we were last year. The peak last year between 25 and 24 got upwards of 33%. We will see inventory climb from this point forward into the summer, and we'll see how big that gap extends. I don't expect a 33% gap. That would be crazy inventory levels. But I do expect this gap to widen off of the 8% that we're currently at off of last year as we get into this peak selling season. Every single week over this month is going to see more new listings, more inventory, more buyers, more activity than you saw in the previous 8 or 9 weeks to start the year. This is a really exciting Monday. It's ahead of us. It's happening. For any agent who's been rooting for a little bit of market condition help, you're going to get the most of it starting now until America's 250th birthday on July 4. Okay. It's all ahead of you. Now, the 1 week here this week, you see this at the end of February. You see volatility often from January until the end of February, where you kind of just see these up and down curves. But what you see in March is the start of the acceleration up on inventory, and that's what I expect. And I'm most excited about the next 4 hot sheets on Monday mornings over the next 4 or 5 weeks. All right, new listings probably had the biggest impact on that 10,000 drop for inventory. Because new listings took a drop the end of February. I called this last week. If you look at places like the Northeast and parts of the country that were impacted by that blizzard, well, you didn't see many new listings in those parts of the country. Okay. And so you're gonna see a bounce back this week and next week. And you're probably going to see a bounce back that is reflective of some of the momentum we've seen in January and February, where most weeks on new listings are above where we were at the same time last year. This week in particular, we see a drop down, but new listings in March last year, they took off. We saw relatively, high spikes from where we are right now. We're at 50,000 over the last week. We had weeks in March of 63,000 and 69,000. Okay. The highest levels we saw last year happened in June and July and May, which, by the way, if you're a seller getting to the market with everybody else, you're losing all your leverage. It's a too late time frame. But that 80,000 to 100,000 is the peak that we're looking for this year. 50,000 last week, long way off of it. We should see pops in March. We're looking for 80 to 100,000 on new listings for a week, which would not be, oh my God, every seller's rushing to the market. Oh no, people are listing their homes everywhere. This is bad news for the market. No, it's quite the opposite. It's normal. It's natural. During the recovery of the great financial crisis, every week, multiple weeks in a row, we saw 250,000 to 400,000 a week new listings. 80 to 100,000 is the low end of what we would expect in a normal operating market. Okay. We want to get to 80 and 100,000. We want to peak out there during this spring season. Sellers are not running for the hills. Homeowners, people who own a home, are not in a position where this economy is impacting them as much as non-homeowners. The sellers are not freaking out about a market condition that's changing. People who own assets are in position to capitalize on everything that's going on. Only 32.75% of properties right now on the market have a recent price reduction versus 34% last year. Sellers aren't spooked that things are taking a little bit longer. Overall, sellers are like, I'll delist. We saw the highest level of delistings last year. Oh, if I don't get what I want, I'll delist and I'll keep the property. I don't have a financial water pistol to my head. I'm ready to go. Okay, I don't have to sell it. A lot of sellers are in a position of strength today. We're still not up over 6 months of inventory across the country. I get pockets, yes. Overall, no. Okay. There's no big financial constraints moving sellers at the same time into the market of saying, I need to sell. And at the same time, you have demand increasing. Yes, off of very low numbers, but showing week over week signs of positive growth, of positive movement. Mortgage application index almost every single week this year has improved versus where we were last year. We have 7 weeks, not only of improvement when you look at the same week last year, but double-digit growth. We have 4 weeks of double-digit growth and 7 weeks of positive year-over-year growth. So 7 weeks, we were better than the same week last year. 4 weeks, double-digit, meaning 10% or more on mortgage application. A leading indicator that future sales in this spring market are going to be better, not worse. A leading indicator that future sales in this market are going to be more plentiful, when you look backwards 60, 90 days from today. 63,000 on weekly pending sales versus 60,000 almost every single week this year on weekly pending sales, according to Altos, has been better than last year. Bobby, let me see if I can find this. I mean, I was making, I don't even want to say his name. I really don't. Let me see if I saved it on Instagram. But there's just, I mean, this guy's a licensed real estate agent.
Airdrop it to my MacBook.
I'll airdrop it to you if I can find this. Is this it? I think I've got it. Okay, here we go. Let me, I want to pull up my comments on this Instagram. This is an Instagram post, worst market crash ever in 2026. And so it's just so laughable, some of the things that we're seeing. And listen, there are agents that are buying into this crap. MacBook, Bobby?
Yeah.
And it wants a code. Come grab my phone. Have my phone and figure this out. I got to show you guys this Instagram clip of the worst market crash ever happening here in 2026. What we just walked through on where these numbers are coming in this year. They're very normal and natural. Okay? Meaning they're getting back to a normal market. There are no signals on any of the weekly data that we're looking at that we're about to experience some huge crash. And on top of it, the rates are even better. The spread between the 30-year and the 10 years is considerably better than where we were last year. We're going to talk about rates and the impact of what's happened over the weekend on rates in a little bit here. But we ended the week last year for the first time since 2022 at a 5.98 on the Freddie Mac 30-year fixed weekly average. Like, all things are pointing better than what we've experienced last. Yeah, actually don't play this. Well, hold on. So basically what this Instagram is suggesting, and this is somebody who's a licensed agent and a lot of agents are following him, and agents are like buying into this crap. It's ridiculous. He's been going on, this one in particular has been going on Instagram saying we're going to see prices drop by as much as 50% this year. And then he kind of backs off that statement because never has that ever happened where home prices go down 50%. And by the way, like 2 months are already over. Like for home prices to average a 50% drop, like the world has got to melt down pretty soon. I get it. This weekend might feel like a meltdown, but I don't think it's going to impact U.S. home prices. So go to the comments here where he's talking about, if you can zoom in, he's talking about things about being really low sales. Hey, buddy, mortgage applications are up. Pending home sales are up. These are both leading indicators that suggest existing home sales get a lift. He's talking about the existing home sale number from December that we talked about, 3.9 million. Being an indicator that existing home sales are going to keep going down. No, quite the opposite. The leading indicators right now is that existing home sales get a lift. And then he ended this by saying, how do I know existing home sales are going down? Because rev share in our company is down. So that means that agents are doing less deal. No, I talked to the executives at your company and rev share is down for many other reasons. It's not just the market. There are many other reasons. And it's not just your company. It's other companies that rely on body count versus productivity. Okay, so I'll leave it there on that. Guys, there is plenty of doomers out there, and your clientele is seeing it. If you don't have motivation to get on the calls, to get on and produce relevant, interesting information that combats this, to talk to people every single day at scale, to have as many conversations today as you can. I would just look at some of this stuff that's going around the internet. Look how many agents are supporting this. You think clients aren't confused when people are saying dumb things online? Oh, they're really confused. And if you care about your customers, if you care about your community, if you care about your database, increasing the level of conversations that you're having right now is absolutely necessary to combat this stuff. Because there is a lot of it flying around, and you have got to be the person that brings rational thinking to your marketplace. It's why we do this every single day. Every single leading indicator is suggesting a very, a lift from 2025. Is this going to feel more like 2025 than it will 2021? Of course. Are we getting a little bit of lift? Are we getting a little bit of positivity? Yeah. Is there any signs that there's going to be a 50% drop in home prices across the U.S.? No, that's Looney Tune stuff. It's not even worth anybody's time debating it. And I can't get those couple of minutes back that I put into the comments. But it's absolutely paramount that you put the opposing message out there, the truthful message out there in your market. Nobody truly knows what's going to happen, but we do know it's never happened that home prices dropped 50% nominally in a year. Even the great financial crisis, it was under 15% nominally in 1 year. Okay, here's another indicator that you might start seeing the market loosen up a little bit this year. Here's another thing that would suggest these leading indicators that we're seeing right now are going to continue to support a loosening up of a market that has been locked in and strangled up here since 2022. Today, more homeowners have a rate above 6% than do the homeowners with a rate, mortgage holders that own a home, below 3%. First time in 5 years we've seen this. So as you see incremental shifts to what I would suggest would be a positive direction, a loosening of the market, a relaxing of a real estate recession that we've been in for 3 to 4 years, the more you're going to start to see some of these oddities about the market flip back. 21% of U.S. mortgage homeowners right now have a rate of 6% higher, highest in a decade. Okay. Highest in a decade. Only 20% now have a rate under 3%. Lowest level in a decade. Market dynamics over time have a tendency of kind of shaking things out. Okay. Here's your mortgage rate distribution landscape. Share of interest, share of outstanding mortgages by interest rate. Okay. So greater than 6% is now up at the same level that we've seen back in like 2015, 2016. Yeah, we had less people that had north of 6% rates in 17, 18, and 19. We have more today. So not just let alone what we were seeing in COVID. We have more people north of 6% today than we did in 18 and 19. Okay, 5 to 5.99%. That's the highest level since around 2016, 17. And we have the lowest level in the last 5 years of under 3%. The trend on that is those are going away slowly over time. And we're starting to see things normalize back to the mean, back to what we've historically seen. Some of these doomers are going to say, historical numbers don't matter because everything's different now. The clip I showed you, his case is a new world order is happening in 2026. Okay, I read Ray Dalio's book too.
People love that's the line.
Oh, that's the line.
New World Order.
New World Order. I think this weekend made it pretty clear who's in charge globally. Okay, it's not going to be 2026 that somebody supplants the United States of America in the pecking order. All regimes fall. I get the history and all that kind of stuff. It takes a lot of time for things to happen. I mean, if you learned anything this weekend, you learned who's in charge globally. Okay. There's not a new world order happening in 2026. The dominant dollar on December 31st, 2026 will be the U.S. The dominant military force on December 31st, 2026 will be the U.S. The dominant economy on December 31st, 2026 will be the U.S. Like, we're not going anywhere in 2026. Okay? And so everyone that wants to pump this misinformation into you that there's a new world order happening this year, well, they've been saying it for decades, people. If you're super young, go ask your parents how long they've been hearing about New World Order. And I'm not talking about the WCW bros, NWO. I'm not talking about Hulkamania wearing the black tights instead of the gold and the red. I'm talking about this theory of a New World Order for multiple decades. 21% of homeowners, they've got a mortgage above 6%. This is the highest level. Look at this. In years. Okay. Market is starting to shift to more normalization. The lock-in effect is finally fading. I didn't say it was over. Okay. It's going to take some of the rain this week here in the Northeast where I am today to get the rest of this blizzard off of the ground. Okay. A lot of it's melted with the sunlight. It's going to take a rain or two coming later this week to finally work its way out. Okay, it takes time to dethaw the lock-in effect. Well, every single day, every single month, March is going to be a big month for momentum. Kind of chips away at that. All right, 13 states are chipping away on property taxes. Very interesting. Florida's gotten all the headlines on this. Florida's been the state at the head of this, saying, hey, it's not only going to be something we're considering, it's now voted into being on the ballot in November in the state of Florida. Kind of one of the governor in Florida, Ron DeSantis, one of his last kind of moves that he wants to make before his terms are up. There's term limits in Florida. No term limits in the state that I'm in here in Connecticut. There's no term limits to governorship in this state, which is crazy. But Florida has term limits. He's going to be gone. He's made a lot of changes. Now, Florida can do this. Okay. Florida, Connecticut, the state I'm sitting in, could never do this. Okay. Florida can do this because there's a surplus per capita. Got the lowest debt or second, one or two. It's one or two every year in debt per capita. There's a surplus in the state, billions and billions of dollars of surplus. And so Florida's in a position to potentially, obviously, maybe pull this off. Still, I have questions about it. Removing a lot of the non-school property taxes is basically how they're positioning that. And here are the other states that are now also making proposals similar to Florida. 13 actively weighing to eliminate these property taxes in some form in 2026. It's not all property taxes, but it's usually some of the non-school stuff. No state has ever attempted total replacement of property taxes at the scale of what's going to be on the ballot in Florida and potentially in now Georgia, Illinois. Illinois property taxes are insane. Indiana, Kansas, Michigan, Nebraska, North Dakota, Ohio, Oklahoma, Pennsylvania, South Dakota, and Texas. Okay, so very interesting that this is now not only a Florida thing where that there's a surplus of cash, but this is across now multiple states. This is catching on across. Now, there's going to be states, Sam says, what are the odds of Newsom? Newsom can't do it. California is potentially in a where they can't support their current obligations. Okay, so states that don't have a surplus, that haven't managed their books, can't do this. Okay, unless they want everything to fall apart. I still have questions on how some of these states can pull this off without letting some things go. But this is now on the docket in 13 states. I'd look for it in your state if it's not there already. As a consideration, if I'm in one of those 13 states, I'm covering that Because listen, if you want to make content that homeowners care about, boy, you touch on taxes. Every homeowner is going to have an opinion in your community on that. Getting different insights from the community is going to be, I think, really relative and interesting. Okay. I said the weekend, if you missed it, was certainly active on the global front. Certainly you couldn't have missed it. Yeah. So very interesting weekend. Treasury yields actually moved up a little bit this morning. We were watching Treasury yields as, okay, what are they going to do here coming out of the strikes in the Middle East here over the weekend? And so Treasury yields tick a little bit higher, okay, which is interesting because you would expect Treasury yields to possibly go down, okay? Prices on the 10-year Treasury move up and yields move down, okay? So when they have this inverted impact, when prices move up, meaning more people want it, prices go up when something is more desirable. Well, the yield moves down. Well, the yield is actually moved up. We're back up over 4%. If we look at the last 24 hours, we were in the 3.9s. That's kind of where we were sitting last week on the 10-year. Well, the 10-year, this longer term investment into America moving actually up on the yield. Okay, so one of two things is true. Either long-term investors, and you did see gold move up, are saying, well, I trust gold more than the U.S. economy over the next 10 years. Okay, that's a theory. Or you're seeing, because they're looking for a safe haven in times of uncertainty. Okay. It's not Bitcoin. Okay. Bitcoin's still hanging out in the mid 60s. Bitcoin not considered the long-term safe haven. Or investors are saying, this is a drive-by. Okay. This isn't gonna last very long. This is maybe a couple week thing. I get it. People are spooked out. People probably don't even like me using the reference drive-by. But what we've seen over the last year is more in and out operations. This one's more complicated than any of them. I get it. I am not a Department of War expert, and I'm not going to pretend to be. Okay. I am not a global affairs guy. What I do know is pattern of in and out. And investors might believe that there is not a long-term impact to the U.S. And they're like, hey, I'm going to make other short-term moves as opposed to flocking to long-term. Like, you knew when Iraq started, like, this is going to be a long time, and people went to long-term safety on their investments. Market's not signaling that necessarily right now, which is interesting. Dow's down another 300 points. It was down on Friday. It's down another 300 points. But you're not seeing a huge sell-off. You're seeing a little bit of a sell-off, but you're not seeing yet a lot. It's going to happen over the next number of weeks. But you're not seeing yet like people fleeing their investments. Interesting. Okay, 10-year is up a tick. We'll see how the spreads move today and impact rates. We ended the week last week at 6% on the 30-year fixed mortgage survey, Mortgage News Daily survey. The week was the lowest since 2022, 5.98 on the Freddie Mac 30-year fixed weekly. So, it's interesting. You would expect, war times, traditional war times, traditionally bring lower rates. And you have a 10-year that's ticking up. It's still very low fours. You're not seeing much volatility after what appeared to be an extremely volatile weekend. Okay, you're not seeing much volatility. So traders don't fear right now wider escalation that is going to maybe involve U.S. long-term. So just that's the consensus around investors right now is like, hey, this is going to be shorter than some people think, and we're not going to overreact. Information can change, things can change, and obviously it's a dynamic situation. But right now, if you're concerned, what's going to happen to rates? Well, rates look like they're probably going to be pretty stable here today on the first day of data that we're getting after this weekend. Everything's new, everything's fresh, but looking pretty stable. Okay. There you go. There's your hot sheet for this Monday. Join the conversation happening in BAMX. Go to school.com/BAMX. You can try it out over the next 7 days. We'll open that up for you with the link down below, school.com/BAMX. Tomorrow and every single Tuesday, we do our live role play, members only, at 9 a.m. Eastern, right before the hot sheet. So join me and Tom and Lisa in live role play masterminds on Tuesdays. You get the replay and the scripts that we use every single week. That's happening tomorrow before the hot sheet. Go to school.com/BAMX. You can try it out. I'll see you guys in there, and then I'll see you on the hot sheet. Until then, have a great day. Good luck today. Toodaloo.